The best of Money Matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Over the past year, equity markets have defied expectations. The bull run has been so strong and so fast that many strategists are finding themselves playing catch-up rather than leading the conversation. Forecasts have been breached, models are being questioned, and investors are left wondering whether even the experts are struggling to keep pace, and if so, how they themselves can beat the game. So what's really driving this bull market? Where do traditional forecasting fall short? And how can investors separate genuine fundamentals over hype? Well, to find out more, joining me now is Danish Lim, Senior Investment Analyst at Phillip Nova. Danish, welcome back to the show.
Hi, Hongbin. Good to be back.
Thank you so much for joining us. Well, Danish, the pace of the current bull market has outpaced what many strategists predicted, that, many are now playing catch-up rather than guiding it. How has it outpaced what you've predicted as well? I mean, how would you assess the current bull market?
Yes, so I do think that the speed was actually a surprise. It was more of a surprise rather than the direction itself. The S&P 500, for example, it's still in line with my forecast at the end of last year. Had a base case target of about 6,540. And I think I just checked this morning, the S&P 500 is at 6,688. So you can see that directionally, I got it correct to some extent. But really, it's the extent of this bull run that has been much stronger than expected. And I think most strategists and analysts fall under the same category. However, I do think that, of course, this is definitely a good problem to have. And I would rather have markets surpassing our targets than missing our targets.
Well, strategists are finding it hard to recalibrate forecasts because of the market's momentum. What's been driving the market's momentum then, Danish? I mean, what are the key blind spots here in forecasting such high momentum markets?
So in my opinion, I think right now we are currently seeing somewhat of a Goldilocks narrative. I think what's really driving markets at this moment is the expectation for more rate cuts by the US Federal Reserve. And I think you can think of it as like insurance rate cuts, mainly driven by softness in the labor market. At the same time, I think we expect economic activity in the US as well as globally to moderate. But I think the consensus is that economic weakness will be somewhat taken care of by all these rate cuts by the Federal Reserve. At the same time, earnings have also trended higher. And even in Singapore, we are seeing, the Singapore markets making new all-time highs, more companies engaging in dividends and buybacks as well. So for the blind spots, I think a key blind spot for any analyst and strategist really is that ultimately any forecast based on educated assumptions, and all these assumptions are ultimately dependent on multiple moving pieces. Remember that we headed into 2025 this year with expectations that tariffs will happen, geopolitical risks will increase as well. But at this point in time, all these risks have really faded away, at least for the past few months. So I think the key blind spot is that, it's really rare for analysts to hit on all these moving pieces, and this will ultimately impact the price targets for analysts, either for the index or a stock.
Well, even bullish forecasters have been caught off guard with year-end targets already breached months in advance. What does that say about the reliability of traditional forecasting models then, Danish? Are they becoming less relevant in today's market environment?
So I wouldn't say that they are becoming less relevant. I would say that they are currently becoming less sufficient, at least in my opinion. I think that your typical single year-end index targets, they tend to age pretty badly, especially with the markets evolving faster and quicker nowadays. I think it's better, definitely, to use a range of targets based on different scenarios, where you replace your usual single year-end target with a range of different targets based on different scenarios that are tied to different drivers, like maybe company earnings or the macro backdrop.
Well, liquidity, central bank policy, and themes like AI have all been cited as tailwinds, but critics argue much of this looks like investors chasing narratives. So from your perspective, how do you separate genuine fundamentals from, hype-driven momentum?
So I think it's definitely true, that there seems to be some form of a chasing of the narrative in the markets. I think that the key to differentiating between fundamentals as well as hype is to look at two key things. And the two key things are the cash today as well as cash tomorrow. So firstly, cash today, investors, I believe, should look at maybe like a company, whether their earnings and cash flow, whether it's trending upwards. For example, a very good example would be Portmart as a company. We see that their hype and all the craze behind their Labubu toys, it's being reflected and validated by their financial numbers as well. For cash tomorrow, investors should ask whether the company has any long-term profit engines, whether they can continue, generating cash in the future. For Portmart, again, using Portmart as an example, they do have, very strong IPs. They create their own IPs, and they have been able to essentially monetize and maximize their commercial potential. So I think those two key things are what will help investors separate genuine hype from false narratives.
Some say strategists risk looking reactive, upgrading forecasts only after markets have already moved. So how do you personally avoid falling into that chasing the tape trap?
So I do think one reason why you see analysts and strategists upgrading forecasts alongside market movements is that really as the macro backdrop evolves, strategists will have to upgrade their forecasts, mainly because of they have to change certain assumptions that they used when they set up their initial targets. There's really nothing wrong with that because, on the other hand, you do have analysts as well who also do downgrade their forecasts. So it's both sides of the picture as well. Personally, I think one way to avoid falling into this chasing the tape trap that I use, as I've mentioned, will be to use a range of forecasts, maybe like 3 different scenarios, 3 different price targets. It could be a best case scenario, a base case scenario, as well as a worst case scenario. I think this is a better practice, at least in my opinion.
Well, for investors, this raises the question, if even experts are struggling to keep pace, how can they hope to, so-called beat the game, right? So what signals or frameworks can help investors stay ahead of the curve instead of lagging behind?
So I do think there are certain key technical signals. A very useful signal will be the market breadth. Essentially, you just take a look at, are there more stocks rising than the number of stocks that are falling? If, there's a higher number of stocks that are rising, this usually indicates that the rally is healthy and that the rally is sustainable. If, however, only a few stocks are actually driving the index higher, typically we see that as a sign that the rally may not be sustainable.
Okay, well, at the same time, every bull run eventually faces reversal. So any predictions on when this bull run will lose steam?
So I don't really have an exact time frame when this bull run will end, but I have to say that although the current market backdrop seems to be headed towards a Goldilocks scenario, I do see a certain window where we could see a correction in equities, possibly in the fourth quarter, around the end of October and I believe early December, which is where the Federal Reserve will make their interest rate decisions. And I think right now, markets are very optimistic that any macro weakness will be essentially controlled and contained by rate cuts by the Federal Reserve. However, if for one reason or another, the Fed refuses to cut interest rates any further, I believe that markets could start to reprice a more shallow rate cut cycle, and this could possibly lead to a correction in risk assets.
Well, Danish, we've talked a lot about how this bull run has left many strategists recalibrating and how investors can stay ahead of the curve. But against that backdrop, I believe Phillip Nova itself is making moves to equip investors with more tactical tools. You guys recently announced the launch of your first Phillip Nova branded ETFs, the MSCI Singapore Daily 2x leverage product and the MSCI Singapore Daily Inverse product. And they're designed for short-term tactical positioning and risk management, marking a milestone for Phillip Nova as you place your name directly on these products. So why was now the right moment for Phillip Nova to, launch these branded leveraged and inverse ETFs? How does this fit into your broader strategy in Singapore's markets?
So I think, Singapore's regulators, they have been very proactive in trying to revitalize the local capital market. MAS, I'm sure you're well aware, has introduced several new initiatives, like the EQDP scheme, the EQDP program to support product innovation. I believe they also came up with new SGX indices as well. So against this backdrop, and I think with Singapore's equity market showing very strong momentum recently, I think we feel that this is the right time to launch our first Phillip Nova branded leveraged and inverse ETFs. I think it's really just a natural extension of our core business as one of Singapore's leading derivatives brokers. And I think this reflects our commitment to offering sophisticated tools that can give investors more ways to express their market views as well as manage their risk.
All right. And before we let you go here, Danish, how are you planning to educate and guide your clients to use them appropriately, especially retail investors who may be new to tactical trading?
So I think something to understand right off the bat is that for leverage and inverse ETFs, they do provide investors with the ability to be bidirectional, meaning they can go long or short SIMSCI index. The ETFs also gives exposure to the SIMSCI, which provides exposure to international listed Singapore companies like C Limited as well as Grab. And compared to futures, the ETF is easier to buy, easier to essentially trade, and there's no risk of margin calls. And if you trade futures, buying the ETF will mean that there's no rollover required. It should be noted, however, that education is therefore a huge priority because this is a pretty complex, I would say quite a complex product. We are rolling out a series of webinars, videos, and bite-sized infographics to help clients understand how these ETFs work, the risk involved, and how they can integrate it into clients' portfolios. Our platform also provides the product fact sheets, the margin calculators, as well as risk disclosures. And our sales and client services teams have been trained to guide investors on their appropriate usage. So ultimately, I think by pairing, this very robust education, investor education, that we can empower our clients, especially newer traders, to use this more advanced, a bit more complex leverage and inverse ETFs more responsibly and effectively.
Amazing. Well, thank you so much, Danish, for your time and your insights today.
Thank you.
Thank you. That was Danish Lim, Senior Investment Analyst at Phillip Nova. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3